Welcome to Daily Tax Savings. This is Tony Novak here to share a few points on saving taxes and staying out of tax trouble. Today's topic is forensic accounting for taxes. Now, when we hear the term forensic accounting, many of us immediately drift to crime, detective type of work. And that is true that forensic accounting is probably most commonly used in some type of uh, detective, criminal, or civil action where we're trying to discover facts and information that aren't readily available. But when it comes to taxes, which is what we're focused about on this show, there are at least 5 different methods to use as a basis to prepare a tax return. We are all familiar with the most common one, and that is bookkeeping, collecting data, the components of which make up taxable income in a ledger format, and essentially adding and subtracting and coming up with that number. That's by far the most popular method. Another method, though, is forensic accounting. And forensic accounting is a critical view of data, not necessarily the components of which make up income. For example, there's just a silly example. If I'm working in a pizza parlor and I look out my window and I see that the uh, pizza parlor across the street has 10 times more customers. For every one customer that comes into my store, 10 go into his store. Well, I can use forensic accounting to come up with an income statement and therefore a tax return for that business on the basis of the facts of the traffic pattern that I observed. That's just one silly example just to make the point. So when we're using forensic accounting, usually it's because bookkeeping records do not exist or may be unavailable, or there's a third possibility where the cost of recreating records either would not be reliable or would be so expensive as to not be worth the price of producing those records for the purpose of doing a tax return. And that's the case today that prompted this episode. I'm doing tax returns for a business person, and in rural areas, there's a lot of them that just do not keep records, or in this case, did keep records, has a whole trash bag full of random papers and scraps. And bottom line is that the business wasn't making any money. Little tiny little business wasn't making any money, didn't have any net profits, and we can show that through other methods rather than spend days or weeks pulling out each little piece of paper and trying to come up with something in the end that looks like a bookkeeping ledger. That just wouldn't make sense in a case like this. So we're going to create the tax returns on a forensic basis. And by the way, I mentioned that there's at least 5 different methods. They can and often are used in combination to come up with the best result. And I'll wrap up by sort of saying this is one advantage. Normally, you don't need a CPA to do a tax return. However, this is one area where you may want to use a CPA when bookkeeping records are not available, and some other method or some other combination of methods needs to be used to come up with a valid and documented and sustainable tax return. You might want to use somebody that has a good academic background in those areas. I'm happy to hear thoughts, feedback, comments, or questions on this topic, either online on social media, or if you want to reach me one-on-one. That's easy to do. Find me at taxproblems.cpa, and the phone number is there. We can plan a time to talk. I'll be back tomorrow with